Video we're going to look at exchange traded funds from the perspective of a fixed income investor. We'll start by looking at what an ETF is. ETF, as I said, stands for exchange traded fund. This means that it can be bought through a stockbroker and you buy it from an exchange like the New York Stock Exchange or the London Stock Exchange. So you buy and sell them exactly in the same way as you would buy and sell shares. They usually charge very low fees. If you compare the fees for these ETFs to your actively managed funds, you will be amazed at how big the difference is. And these hold thousands of bonds, usually thousands, which gives you very good diversification. You couldn't get that good diversification if you were buying bonds unless you got an enormous portfolio. And they are far, as I said, far cheaper than managed funds. I don't think anyone should be investing in these expensive managed funds when these ETFs are so much cheaper. And we'll look at the benefits of ETFs. As I said, huge diversification. If you imagine you were buying 1,000 bonds and they were £100 each, it would cost you about 110,000 for that level of diversification. So these things make sense from a diversification perspective because you're not going to get that sort of diversification on your own without a huge portfolio, and it significantly reduces losses and defaults. That's very important, because if you imagine you hold 5 different retail bonds and you buy them when they're issued at £2,000 each, paying a 5% coupon, you hold on to these, right? But one of them defaults before it pays anything. Completely random, unexpected event, and it blows up completely. Not impossible, not likely, but could happen, right? That would mean you would need to hold the remaining 4 bonds for 5 years, and then you would earn nothing. It would actually be a negative rate of return after inflation. So diversification protects you from those big losses. The bond market's quite volatile, it will go up and down over time, but if you hold on to it, you shouldn't do too badly. You should do pretty well, actually. Not as well as stocks, but it's another thing. Also, you want to consider these Lifecycle Funds. These are a relatively new thing, especially in the UK, but they're a pretty good idea, especially for your pension, if you manage your own pension. They're very simple to invest in. You just buy them like you would a normal fund, though watch out, some stockbrokers are not too fond of them because they don't pay them anything. The fund automatically adjusts its asset allocation as you age. So each year what the fund invests in changes, and it automatically rebalances. So as you age and as the market conditions change, it will maintain a strict ratio of stocks to bonds, which if you were doing yourself would create far higher brokerage fees than the fund. It can do it far cheaper, and they do charge really tiny fees, and they're offered by Vanguard. I think other companies probably offer them, but they'll have a very hard time competing with Vanguard. And I really do believe the ETFs are the best option for most investors. If you're going to be investing in bonds, you have to seriously look at using ETFs. They are the best route towards diversification. The costs are really small. The benefits far outweigh the costs, and the costs are tiny. If you do the calculation in terms of how much you're actually paying the company, it's absolutely tiny. Protect yourself from yourself. You often overestimate how good you are at picking out bonds, and it is quite difficult to really research a bond and really understand the risks and how likely this company is to be able to pay, whereas with an ETF it just buys so many bonds that you are protecting from misallocation, which most investors do actually need. These things are also very tax efficient. A lot of funds that are actively managed buy and sell far too much. They move around very aggressively, which is not good from a tax perspective. These funds manage tax very well. And another interesting thing that some investors overlook is you've got some of these funds are actually capitalizing in the sense that instead of paying out cash, you get more shares. So it automatically reinvests your coupon payments to buy more bonds. And though these are usually slightly more expensive than the sort of Vanguard funds, the very cheap funds, I think they pay for themselves. Because if you were going to reinvest this through a stockbroker, you've got to pay brokerage commissions, where these capitalizing ETFs do it for you, and they do it at far lower cost. You got to do the maths to make sure, but I think in general you'll save by looking at these capitalizing funds. So have a look into ETFs if you don't already have them in your portfolio. They should not be overlooked. They're very important and they're a very, very good idea. And that's all.